Good afternoon. It's Tim McAleenan here, and welcome to the very first podcast I'm making for the conservative income investor. I wanted to start making some short YouTube videos to supplement my writing content for things that are very narrow points that don't deserve an article of their own, but are also a little bit longer than something that would, say, work on Twitter or something. Today I wanted to talk about Nike stock in particular, and more generally the principle of sticking with businesses that have earnings per share growth rates over 10% that always seem like they're trading at a higher price than you're comfortable paying, and certainly at a higher price than was recently available. And it's a mental block that I know I've put up at times, where you look at something that's like, ooh, a couple years ago I could have gotten this price on the stock, and I didn't think it was cheap enough, so I didn't buy it, and so I waited for it to come down, but the earnings per share kept growing, and then a good price never came. I don't know what if there's an economic jargony term for this, but I imagine it's probably closely related to the sunk cost fallacy, where you look at something and you think, oh gee, because I couldn't get it at $20 per share, I'm not even going to consider it now at 30 because I didn't act when a better deal was previously available. And the purpose of this podcast is to try to show why it might be worthwhile to switch your viewpoint towards saying, okay, what's the best thing I can do with my money based on the opportunities available to me today? If there was something, that could compound at 14% last year, and the best thing I can find today is something that might compound at 12 or 13% going forward, that's still a worthwhile thing to do, even if it's not as good as a previously available opportunity. And to prove this point, or to at least show an example of it, is let's look at Nike stock over the past 10 or 11 years. If you could go back to 2005, you would have seen Nike trading at about $10 per share. Now, when I say that, I should warn you that Nike has had 3 stock splits over that time frame. There was one in April 2007, December 2012, and December 2015. So when I talk about Nike trading at $10 per share in 2005, I'm adjusting for all those stock splits. So if you were actually there in 2005, you would have actually seen Nike trading at $80 per share. But because each share has been sliced into 8 new pieces since then, I'm referring to it as is $10 per share. For instance, when you look at Nike's price now and you see it at $55 per share, if there were no stock splits since 2005, Nike stock would actually be at $440 per share right now. So that's the caveat I wanted to get out of the way before we go ahead. Well, if you looked at Nike stock in 2005, it was trading at $10 per share, and it was earning 56 cents per share. So it was trading at 17 times earnings, which was, a heck of a good deal for Nike at the time. And if you looked at it just 12 months later, by 2007, the price of the stock shot up to $17 a share, and the earnings only went up to 72 cents. So if you look at that, the price to earnings ratio went up to 23.6 times earnings, and that was in 2007. That was when we were on the brink of a recession that basically cut the price in half by 2009. And you might wonder, well, why the heck, if you were sitting there in 2007, why would you want to pay 23 times earnings for a stock that was previously available at 17 times earnings? That just doesn't seem to make intuitive sense. But then you realize, well, the reason you do it is because Nike's still growing at 15% a year. So on an absolute basis, even though the 2007 deal wasn't nearly as attractive as the 2005 deal, it was still something that was objectively very intelligent to do. When you look at the price of $55 per share today, and you compare it to $17, that's over a tripling in price, which you actually would have gotten more than that because Nike pays out a dividend. It's not much, but it would give you, if you invested $10,000 in Nike in 2007, you'd have over $30,000 today, and that was investing on the eve of a recession at 23 times earnings at a valuation that was well over 50% higher than what you could have just gotten 2 years before. And keep in mind that at the time you would have been looking, when it was at $17 a share, it would have been at $136 in real time. So if you were actually looking at a stock portal, you would have seen Nike go from $80 per share in 2005 to $136 per share in 2007. That's not adjusting for stock splits. And I imagine there were a lot of people who saw that figure and they're like, oh, Nike just got overheated. Oh, I'm not going to buy that right now. It's too high. I'll wait for it to come down. And that opportunity did come. If that was your attitude and you scooped up shares, during the recession, you would have quintupled your money if you got it when it went back to 10. But that type of strategy, while extremely lucrative if you're able to execute it, sort of relies on a recession being in the offing. If it was 1982 to 2000 and that was your attitude, you would have had to have waited over 18 years before another opportunity like that would have presented itself. And I don't think you can necessarily rely on 2009 type of environments coming, because we've only had maybe 4 or 5 of them in the past century. And so maybe if you're later on in life and you have a lot of productive assets, that kind of patience might be worthwhile. But if you're early on in life, if you're middle-aged and your thought process is on acquiring productive assets, I don't think that stagnant capital and just sitting on large chunks of cash is going to be what's best for you. You probably should be asking yourself the question, okay, out of all the opportunities that I can see around me today, what's the most intelligent thing I can do with my money? And I think a lot of times it's going to point you towards stocks like Nike, even though they always seem to be trading at a valuation that's a little bit higher than you would like to pay. Nike's at $55 a share right now. It's earned $2.15. Expected over 2016. That's a price to earnings ratio of about 25 times earnings, and if you adjust it for the strength of the dollar, it's about 23 times earnings. And so it's very similar to the 2007 situation, and it's like, well, if there's not another 2008 or 2009 recession around the corner, like being patient and waiting for a better price, that may not be the best thing for you to do, because the people who just said, you know what, it's 2007, it's a little bit higher than I want to pay, but I'm just going to write the dang check, those people have tripled their money in less than 10 years. That's not... It's very difficult to say that there's a lot of things that you could do that would be more intelligent than buying Nike. So one of the things I hope this example shows is that you should pivot away from saying this deal isn't as good as what was previously available. Your question should be, okay, what do I expect the earnings to be? What is my conviction rate? How confident am I that those earnings will actually pan out? And how much, if anything, do I think that price-to-earnings compression will take away from this? In my case, I look at Nike at 25 times earnings. I think, okay, maybe over the long term it'll come down to 20 times earnings, but you have a good chance of getting 13, 14, 15, maybe even 16% earnings growth while that price to earnings compression might be happening. So you'll still be getting, I don't know, 12% returns if you buy Nike at $55 per share today. So when you analyze it, instead of saying, I'm not going to consider it, its price to earnings ratio is too high or it's not as good as what was previously available, I think your thought process should be, okay, all things considered, Nike at $55 a share is probably going to be a 12% compounder over the next 5 to 10 years. Can I find any other publicly traded stock or investment available to me that will compound at a rate higher than 12%? If you can find that, then do that. But if you can't, then I think you should give a stock like Nike a good and hard look. Well, that concludes the first podcast, and thank you for listening. I appreciate it. Hopefully there will be more this week. Have a good day. Tim.